Good morning and welcome everyone to the Moneycontrol live stream. Festive greetings to all of you. You're watching The Opening Bell and I'm your host, Nickey Mirchandani. Well, markets look set for a positive start in the holiday truncated week. SGX Nifty indicates extension of the previous session's bullish trend for Indian equities, and Asian markets have been trading higher even as China has set a lower bar on the growth. US stocks ended higher on Friday. Nasdaq scored its best day since Feb. Well, the rally was driven by the speculation that Federal Reserve won't raise interest rates beyond peak levels. The markets will remain shut on March 7th. Well, in terms of the FIIs and the DIIs data, FII bought shares worth around 246 odd crore and DIIs have bought to the tune of around 2089 odd crore. Sweeping statement made by Mark Morbius out there. India market is the best option, says Mark Morbius in an interview, and also says be careful about putting money in China. Let us get going and discuss some stocks and strategies today with Sudeep Shah, who's the head technical and derivative research desk at SBI Securities. Sudeep, good morning. All right, markets have clocked in the highest single gain since November 11, 2022 on Friday. Presently, Nifty is in an attempt of staging an upside breakout of the initial hurdle at around 17,600 level. What's the next upside resistance level, Sudeep?
Good morning, Nikki, and good morning to all the viewers. Absolutely, like you've said correctly that the markets in the last couple of days has given a good rally, a good rebound, a strong one. Much of it also has to be with the global markets. We can link it with the global markets because in the last 3 days, even the US equity markets have given decent returns. The internal breadth of the S&P index also has improved compared to the last week. Now, going forward, there are two levels which are important that with this rebound rally, index has not only crossed its 200 DMA at 17,400, it has also crossed and sustained above its 200 exponential moving average at 17,580. So the next resistance would be around 17,800, 17,820. This is exactly the gap area which is created on the 22nd February gap down. So I feel that the rally could extend till 17,800, 17,830, but that is where we need to be a bit cautious because the highest call writers also are placed at 17,700 and 17,800. On the downside now, what last week's action has done is that at least it has tried to create a floor around 17,400, 17,500. So a dip to 17,500, 17,480 would be a good area to go long, and I see a more probability of 17,400 and 17,800 acting now as a range on both the sides.
All right, range. It's also an holiday truncated week. So there is, we are looking. How do you look at the strategy coming in on this week for Bank Nifty index as well? There has been some support coming in from Bank Nifty overall. Do you expect that to continue? And what are the immediate support and resistance levels?
See, what Bank Nifty has done is on Friday, it was a 1,000-point rally. Now, Bank Nifty, with that, it has crossed and closed above this 40,900 mark, which was the 20-day exponential moving average and which was acting as resistance for the last at least 10 to 12 sessions prior to that. So having closed above that, now 40,900, 41,000 will now act as a strong support on the downside. Significant put writing also has been happening at this 41,000 strike price on Friday. So I feel that this zone of 40,900, 41,000 will act as a strong support. On the upside now, 41,700, 42,000 will act as a resistance because 41,500 and 42,000 are the strikes where there is some significant call writing also happening. And with tomorrow markets shut tomorrow and a lot of important data to come out from the US tomorrow, as well as there's a speech by Powell. So the markets would be on tenterhooks because of those events also, and we might see some kind of resistance around 41,800, 42,000 on the Bank Nifty on the upside.
Sure, Sudeep. Also, Sudeep, I would want to chat about two important things quickly before I address the movers of the day. The strategy on Yes Bank, because the lock-in period, the 3-year lock-in period rather, ends today, and your strategy on Adani Group of companies.
See, I won't be able to discuss more on Yes Bank because SBI is one of the significant shareholders there due to compliance reasons. But about on a stock specific level, I feel the stock around 15 and a half, 16, where the 200 DMA is placed, the stock is on a lower top, lower bottom kind of a scenario. We've been on the charts, we've been seeing some pressure. So until and unless the stock crosses 18 on the upside, I don't see any bullish momentum to restart on that stock. 18 and a half are the levels to watch out for the upside. On the downside, 15 and a half will be a key support. Below that, there could be some weakness creeping in further on this stock. So on the Adani group, Adani stock, I feel, see what's happening with the Adani stocks is it's like a tale of both the cities, gap ups, gap downs. But in the last few sessions, what Adani Enterprises managed to do is post 5th January, it could not cross its 20-day exponential moving average. And yeah, Friday was the first session when it was possible for the stock to cross and sustain above that. So I feel now going forward, 1800, 1820, if anyone is holding this stock, has to be the trailing stop loss. Once again, if the stock breaches and closes below 1820, 1830, I feel once again the downtrend will accelerate. So for Adani Enterprise, 1830 will be the key level to watch out for.
All right, Sudeep, just stay on the sidelines. We'll quickly address the top movers of the day. Adani Group of companies, new age stocks and old economy stocks are expected to be in focus. So you have the whole ambit out there. Adani Power, there is a Supreme Court relief coming in for Adani Power. It's allowed to receive in compensation, and Supreme Court has dismissed the appeals filed by Maharashtra State Electricity Distribution. The case relates to the change in the law for non-supply of domestic coal. So some win out there. Adani Ports and Adani Total Gas, there is a bit of negative coming in on that one. ICRA has revised the rating outlook to negative from stable. The deterioration is on account of group's financial flexibility, which has led to the revision per se. Do remember that GQG only on a Friday, Thursday evening reported that it's going to be investing in money on Adani Group of companies. So that was a significant development, and we saw the entire bunch of stocks doing extremely well on Friday. Britannia, there is a downgrade coming in on that one. CLSA has downgraded the rating to sell. With a target price of around 4,060 odd rupees per share. It says high wheat and milk inflation is expected to impact the margin growth of the company. The top line growth is expected to be driven by volumes, but it has slashed the earning estimate by 1 to 11% for FY23 to FY25. However, the long-term view remains to be positive, but there seems to be margin pressure building in for that one. A more than 30% run-up has been seen in the stock over the last 1 year. Nykaa, that one, another one, is expected to be on our list today, or is on our list today rather. Macquarie has initiated an underperformed rating on this one as with a target price of around 150 per share. It says that the company has been facing risk coming in on the beauty segment, margins as growth moves to smaller towns and offline competition. It also sees some amount of threat looming over the company given the experience from the physical retail. It makes them feel a little cautious on the own brand, and also the focus remains limited on operating history, and the need for growth, of course, is the key point coming in on that one. It's also a bit of cautiousness has been underlined here on account of the EPS growth of the company. And of course, in a very important development, Yes Bank, there is a relief coming in on Yes Bank with, the lock-in period now getting in expired today. So a lot of action is expected on that one. But we're going to be quickly waiting on the sidelines for the market opening just to see if the mood is as positive, just the way we left on Friday in the holiday truncated week. So remains to be seen how is the market right now faring. Okay, with the Nifty 50 Are we looking in some positive amount of traction building in on that one for that matter? And how is the global setup actually giving in a positive handover for the Nifty 50 index overall? If you talk about the Sensex also, we're looking at a positive start coming in on that one. 0.5% gains coming in for Sensex too. So we are looking at a positive number coming in for Nifty. Bank Nifty index, where we're seeing some amount of positive gains coming in on that one. 0.5% gains coming in even for Bank Nifty index overall. So it remains to be seen if the broader index too seems to be participating into the rally right now. We're looking at 0.5% gain coming in even on Nifty for that matter. So clearly a positive start coming in for the markets. Participation coming in from the broader index, participation coming in from the Bank Nifty index. Metal index too seems to be doing well. We're seeing gains of more than 1% coming in on that one. So clearly net a positive sort of day. We aren't reading much really in the opening deals for the markets, right? We are going to be looking at the intraday activity per se for the markets. Nifty Pharma Index, we are also seeing some amount of gains coming in from the defensives, that is IT, as well as Pharma Index. Bank Nifty, Auto Index, all of them right now are trading in positive, clearly giving in a positive handover for the markets. Markets seems to be celebrating and having that festive cheer around the corner. FMCG index basket 0.2% there, gains out there. Clearly we are seeing traction building in gradually for the markets. And if you talk about the market breadth, well, 41 stocks advancing as against 9 declining ones. So clearly we are looking at 17,700 sort of level coming in for the markets. And if we can also address the top gainers and the top losers of the day, just to see how Adani group of stocks have been doing, because we saw some amount of traction building in on Friday there. Adani Enterprises, Adani Ports, HCL Technologies, they're all in positive. Infosys, TCS and Axis. Now do remember it's IT and Adani's which are technically at the top of your list, and also we have Tata Motors, Reliance, UPL, which have been doing well. Britannia on the other hand, there's a downgrade coming in which we marked earlier in the trade today. JSW Steel, Tata Steel, we're seeing some amount of negative momentum building in for the commodity stocks despite the China reopening. Probably the growth number coming in for China seems to be weighing down on the sentiment. Also, clearly right now it's the sea of green that we're looking at for the markets. But Sudeep, quickly, if we could mark also Yes Bank before we could go to Sudeep out there, just to see how the market momentum has been faring in for Yes Bank and understand if there is a volatility playing out in that one. Sudeep, first let us know about your assessment on Adani group of stocks now. It's been doing well. Another session where we've seen a positive opening coming in on that one.
Absolutely, Nickey. See, Adani's enterprise, which the way the gap up has happened and it's sustaining about 2000. So I feel now going forward, 1930, 1950 zone will act as a strong support, and till the time the stock holds above that, it could make a up move up to 2100, 2130 on the upside. The major support for from an investor standpoint, from a medium-term trader standpoint, would be 1850. From a day trader's perspective, 1960 will be the intraday support, but overall 1850, 1860 will be the key support that one should now look out for, because that is the zone of 20-day exponential moving average, and the stock has never been able to cross that. Say the time it has started falling from 3800. So this is the first signs of reversal in this stock. However, it's a bit early to speak about Adani Group stock, because you don't know, someday there is some news coming and again it opens 10-20% on the downside. So it's a very, very volatile situation here, but anyone who is holding the stock should be holding it with a 1960 stop loss from an intraday perspective and 1850 from a positional perspective.
All right, Sudeep, we'll leave it at that. Thank you so much for taking out the time and speaking to us.
Thank you.
All right, it's that part of the show where we bring in our fundamental guest of the show here and talk about a bit about how the markets have been faring. We've spoken enough and more about the Yes Bank and, for that matter, even Adani group of companies. But let's bring in our guest, Jigar Mistry, who is the co-founder at Bouyant Capital. Good morning, Jigar.
Good morning, Nickey.
All right, we're going to start about the financials first because there was a significant underperformance that came in on the benchmark since the start of the year, despite being the outperformers in the previous year. You think El Nino combined with higher rate interest, combined with the news that flow that you're looking at now from Adani group of companies, how is that expected to weigh on the financials coming in for overall banking as well as NBFCs?
Right. First of all, thank you so much for inviting me on your show, Nickey. See, I think if you sort of track financials, we are looking at 3 or 4 cycles, right? The first is the credit growth cycle, then there is a NIM cycle, then there is this whole credit cost cycle, and last, the valuation cycle. Now, so if you sort of take a step back at first and look at markets and financials prior to 2015, things were very different, right? Because there was sort of a lot of evergreening that went on. And once the AQR, the asset quality review, was advised and IBC came through, that's when you saw a lot of corporate debt sort of pop through, and 16, 17, almost part of 18 went through with that. And then there was the ILFS crisis in September 2018. So post that, the entire banking balance sheets have been pretty clean. I would say at least for the past 20 years that I've been looking at. KV Kamath says 50 years, so we probably can take his word for it. In that scenario, a rising interest rate essentially would result in a value of a bank which is higher because they tend to reprice their assets faster than they reprice their liabilities. Now that these sort of rates have increased and NIMs have expanded, there was a lot of market chatter regarding whether NIMs compression would come through. And, I had written some time back saying that we don't see a dramatic case or a case of a dramatic fall in NIMs, although, 10, 15 basis points is par for the course, and that could come through. Now, in the process, your credit growth continues to remain very, very strong. And the rising sort of, interest rates used to bring with its own share of, higher gross non-performing assets. But, if you look at the past 4 or 5 years, majority of the lending has happened into the personal loans category. And in that scenario, they are unlikely to sort of default en masse. And therefore, all your 3 cycles are essentially in the positive trajectory. Your NIMs are compressing, but not that hard. Credit growth continues to be fairly well. Credit costs are unlikely to play up in a big way. And therefore, people have chosen to play the valuation cycle slightly differently. So if you look at, say, HDFC Bank and Kotak Mahindra Bank with impeccable asset quality across cycles, they've always valued at a very high valuation. And therefore, they didn't fall as much as the others and, adequately didn't rise as much. But, initially what came through in terms of ICICI Bank or SBI, where people, assume that if GNPA falls down, then all these banks should re-rate, and that is exactly what happened. Then came the turn of all the PSU banks, and a lot of people chose to play the valuation cycle on that accord. And I think that's how it's been continuing. As we see it now, I think all the sort of arbitrage opportunities, if you will, have been addressed, and we are not looking at sort of that playing through. So now it will be, the nuances of the bank, how banks manages its own liability franchise, the individual CD ratios, the sort of the nuances of the banks will start playing out. As a fund, we have sort of exposure to a lot of the names that I mentioned. And I think ICICI, HDFC Bank, sort of SBI does remain our top pick as we speak.
Sure. Also, let's chat a little bit about Yes Bank and, the development thereabouts, which has come in on account of the 3-year lock-in period now getting, lifted today. Yes Bank 3-year lock-in period has ended, but there was returns that SBI and other made on this investments. How do you look at this whole development and SBI investment in Yes Bank as compared to the other financials? How would you kind of read into this?
Difficult to say, Nickey, because see, if historically, I think as in when the lock-in periods have opened up, a lot of banks have chosen to exit that investment. And therefore, in the shorter term, it stops being a fundamental question, but, tends to become a lot more flow-driven question. And then, we don't really have a lot of understanding into whether, if at all, these banks would want to sell and move ahead. And therefore, sort of if we wanted to increase the risk on the sort of, you want to play duration, there are different banks you do that. You want to play credit, there are different banks to do that. And Yes Bank sort of did not really factor into at least our assessment of things. So, given that variables are literally uncontrollable as far as from where we see it, it's not really come into our radar.
All right, just a little bit of stats out there for our, viewers out there. SBI, which initially acquired in 49% stake in Yes Bank, held around 26% stake in the private bank as of December 31, 2022. That remains an important development. But apart from that, we are quickly going to go back and chat about the underlying financials. Jigar, do you see the FII trend now reversing anytime soon? There were statements coming in from Mark Mobius saying, there were sweeping statements actually, said that India is a good opportunity, India and Brazil for that matter, both are good opportunity. And it's, people now need to be, the investor need to be more cautious coming in from China. How do you look at it? Do you also see FII's trend, which has been subdued thus far for the span of 4-5 years, reversing in this year?
It could, Nickey. So, if you look at the entire ecosystem or the entire sort of scan through the geopolitics of a lot of countries, the fundamental point most FIs sort of look at as far as they're evaluating the country over a longer term is whether sort of their labor force participation is likely to increase over the next, say, a decade, 2 decades. And, productivity gains, there is a room to play through that or not. And if I look at any country today, right, China, Japan, sort of lot of which you can classify as not completely developed economies, then India really stands out because, you have a lot of young people sort of joining the population. And the common argument is that, there's a lack of job, etc. But today they are just drawing from the sort of pool of resources. And tomorrow, even if they contribute in whatever meager way, that actually becomes a very large point when you look at it from a decade or a 2-decade standpoint. So, India clearly is in one of those bright spots. Unlike Brazil, it's not really a resources dominated economy. We have a fair share of consumption. We have a fair share of financials. Softer aspects are reasonably good judiciary. The law of the land actually generally holds true. So it will be a very interesting destination. But as we speak, FIs already are the largest cohort besides the sort of promoter group. And, although mutual funds and people who run alternative assets like us are sort of joining in, but still FIs are in excess of 20%, which is a very meaningful ownership in a market like India. Over the shorter term, however, I think a lot of this, flows are determined not just by the long-term sort of interest, but also regarding how, interest rates are panning out. And there, I think we still don't have a lot of clarity because if you talk to a lot of economists, they will say that they are expecting at least 2 hikes, if not 3. And thus far, the RBI has not followed suit. But now, given where the rupee dollar is, it might pretty much be a 1-to-1 correlation, wherein, if you see a, say, 75 basis point hike, then RBI will be doing the same. In that scenario, if sort of dollar were to appreciate, a lot of FI start selling all sort of all risky assets and emerging markets, and within that, India does fall into that category. And therefore, you might see that the flows do not continue to remain very, very strong. Again, you sort of zoom out into a little more medium term, things are reasonably good. We are probably looking towards the end of the rise cycle. And if the markets were to correct, which I think could be a fair course of action over the medium term, then I think you can't completely rule out India, as a market, not that, what I'm saying is not appreciated. It trades at a fairly higher multiple vis-a-vis if you look at a lot of other economies, right? A lot of sort of countries which say 30% ROCE, say 15-odd%, 20% growth are not getting valued at the kind of valuation a lot of Indian companies see. So I think it's sort of path determination that most of them will go through. Yes, we are interested over the longer term, but into the shorter medium term, we would like to see what prices the assets are offered to us, and then choose to come in when we think, things are very interesting.
Sure, Jigar. I mean, I'd just like to highlight that although the valuations at this point of time are higher, that's also because of the kind of fundamentals overall that the economy has been enjoying over a period of time, right? But I'm going to quickly also chat about the point that you just made about hiring activity, and speaking a little bit about defensive space also, because hiring activity has resumed now in Indian IT sector after month-long of slowdown and layoff and all that news and negative developments. What do you make out of the sector, and do you see a defensive now shining more than the financials?
Right. So, it's sort of the nomenclature defensive or aggressive here, it slightly pertains to how we treat a lot of these indices, right? So if you go back and look at, say, 2020, when the COVID sort of onset happened, and 2021, when, things looked as if there is no tomorrow and everybody started hiring very well, two things were transpiring. Yes, people went ahead and hired a lot. To some extent, they hired a lot more than they should, and which is why you saw a bit of a slump coming back into the later half of 2022. But more importantly, Nicky, India does not really have tech plays, right? What they do have is IT services plays, and two are fundamentally different. Tech is something like, say, a Zoom, which will quadruple or quintuple revenues any given year. And a small change can lead to dramatically higher profitability over the course of the next few years. Unlike that, Indian IT is a reasonably good, predictable earnings, very strong cash flow, very strong balance sheet structure kind of a play, wherein you don't really simply have, just the growth potential that a lot of these tech players do sort of come out with. And therefore, when sort of Indian IT services got re-rated with the tech plays, I think that was a bit confounding to us. And then when sort of the Nasdaq fell 35% last calendar year, the IT services companies have corrected with them. So I think it was wrong for them to sort of follow Nasdaq and wrong for them to follow them back down. But I think that distorts the 5-year average. And therefore, when you look at, say, a 10-year average for valuations, these stocks are not there fully yet. So yes, increasingly fundamentals are appearing to be reasonably good. Valuations have corrected a little bit, but it's not a case where they are completely screaming buys. Nevertheless, compared to 2022 calendar year, as I see the portfolio for Bouyant today, we do find a slightly higher sort of an exposure to a lot of these tech names, and therefore it's a zone where corrections now gets the stock to a more interesting level rather than going ahead and buying them outright.
Sure, Jigar. Also, your view coming in on these new age stocks. There was an initiation report coming in from Macquarie today on Nykaa, where they suggested that there is a limited operating history for the company, and there is more need for growth investments per se for companies like Nykaa. Within that basket, which are the companies that you think seem to be reasonably valued as well as have an earning potential at this point of time, given the definite commentary that some of the management have given thus far?
Sure, Nicky. So I think let's break this down in two parts. I think it's not as much a fundamental question because some of these are reasonably good businesses. But I think what in 2021 a lot of people did not realize was that when you look at a lot of these assets, these are, how should I put it, the ultra high duration equity assets, as I call it. Meaning, think of, say Netflix, for example, right? It made operating cash flow losses for, say, a decade. And then it started reporting a reasonably strong sort of growth in cash flows. Now, when you sort of discount that cash flow stream at a 0.25% US risk-free rate, if you get, say, a value of 100, at 2% or 3% risk-free rate, you don't get a value which is, say, 10% or 20% lower. You get a value which is 60-70% lower because, your positive cash flows are so much out in the future that a discount rate impacts the valuation of these business dramatically. It's sort of a parabolic curve, if I can call it that. Now, the question is that how and when the fundamentals take over and whether the cash sort of the rate increase cycle is behind us. I still think there is not a case where the risk-free cycle is behind us. The rate hike cycle is behind us. And therefore, it might behoove us to sort of keep them on the radar. But again, buy them, not at a time when things are looking extremely hunky-dory. I might sort of bring you back to the year 2006 when the Fed fund rate peaked at, say, 5%. S&P rallied 20%. And then the sort of 2008 global financial crisis happened. Now, if I look at the new housing sales today, and as well as the new housing starts, it's falling at a faster rate than the 2006 cycle. Now, admittedly, a lot of banking sector exposure and leverage is not as high as we saw in 2006, and therefore you might not have this sort of a very large theater, very small exit, and somebody crying foul, which leads to stampede scenario, which means that there is no rush to get out of a lot of these businesses. But nobody can sort of negate the fact that real estate in the Western markets is taking a bit on its sheen, and therefore you cannot sort of start playing on the wealth effect, and therefore you cannot start off look at inflation coming down in a big way as the Fed would want to. So I think, yes, they've corrected a lot. Yes, some of them are interesting businesses. But again, it's time to keep them on the watch rather than, going extremely gungo on a lot of these names.
Also, your word coming in on the overall commodity sector, because there were high hopes pinned from China reopening, right? Doesn't seem to be quite playing as per the book. Do you expect more pain coming in for the commodity sector? Sure, in the trade they could be doing well, but do you see more as a short-term relief rally coming in on these counters on account of the drubbing that has been witnessed, or do you see an underlying fundamental change for these companies?
Right, Nikki. So, I have been a commodities analyst most of my life. And I think if you have lived through the 2002, 2008 sort of the rally, it's difficult to sort of even get moderately bearish on these names. But I think we need to take cognizance of the fact that fundamentals have changed dramatically, right? There was a country that needed to create infrastructure and it was in a hurry. China sort of took the entire demand by its sort of horns, and then it rode the bull very, very sharply. Your commodity prices were growing at a fairly sort of standard stick. And then, and you were coming off almost 20 years of zero investments into the sector. Now, if I look at that sector today, I see a very different picture. Most of these countries have created, artificial walls around steel imports, etc. And therefore, it becomes a pretty much policy-driven sector rather than a fundamental demand-driven sector. Also, for the non-ferrous side, I think, non-ferrous arguably is a little more interesting because China has fundamentally changed colors, right? It no longer wants to either sort of drive the demand or drive complete supply as had happened over the course starting 2011 onwards, pretty much into 2017-18. So I think we have none of those scenarios, in which case fundamentals can try to take over. In which case, I think the prices could continue to remain where they are or slightly move up. Sort of equilibrium might balance. Now, China opening, I'm not very, very excited about that because China opening just doesn't drive demand as much as it also drives supply, right? And therefore, you're not seeing a scenario where your net imports from China's end is increasing at a reasonable click, and therefore the pricing impact you hardly see on even the exchange traded metals, right? So steel obviously is not one, but aluminum or zinc or copper, they should have shown a fairly strong pickup, which is not visible. So then the question comes down to if they are sort of beaten down a lot, you sort of get into it. As we speak, we don't have a huge exposure to any of these names. My sort of interest has always been to, buy them when things are really bad and sort of management has thrown in the proverbial towel. But besides that, I think, if they offer to us at a reasonable valuations, we might look into it. But today, they're not sort of up there yet.
Again, we just said that with a reasonable valuation, you might want to look at it. But between ferrous and non-ferrous, which is the segment which you'll prefer most at this point of time if the valuations were to correct a little bit?
Non-ferrous, Nikki, because non-ferrous there I can make a case for aluminum, for example, right? Because if I track a 150-year aluminum cycle, aluminum is the newest metal, right? Steel, we have thousands of years of history, but aluminum was invented only about 150, 160 years back. And, it's gone to destinations which are very energy intensive. Of late, since China came in, China sort of thought that I can actually produce aluminum even at a very high cost. and still get away with it, because otherwise I might have to pay top dollar to, the Norsk Hydros or Canadian Indian manufacturers. Uh, since then, we have seen some dramatic sort of things happen which they never taught us in the 101 economics class. So never before was the largest cost producer of aluminum also the largest exporter, right? Because they import alumina, they import bauxite, they import coal to make power, and then they used to export aluminum. Now, China has changed tracks. They are much more interested in sort of building out the ultrasonic missiles, which NASA cannot, and not really focus a lot more on this brick and mortar businesses. In which case, aluminum prices have come back to a little more normalcy, but they are not yet demonstrating a place where demand supply is completely balanced and, prices are moving up. So within the two, I think a lot more faith of mine resides within the non-ferrous complex than the steel complex.
All right, Jigar, really interesting conversation out there with interesting insights and observation from you, but we'll leave it at that, completely running short of time. Indeed, a pleasure chatting with you. All right, with this, it's a wrap, and goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen for the rest of the updates. Stay tuned into moneycontrol.com and Moneycontrol app.